with us from Philip Nova. And who do we have in the studio today? We have professional trader Tom Yuen. That's him right there. You see him in the webcam. He's all set in the studio and he's ready to share with you how you can learn behavioral finance through the lens of a professional trader. Today we will be covering um, what we will be covering is basically this. Have you ever wondered why people tend to buy near the market high and sell near the market low? Do you sometimes find it difficult to follow the news or analyze the fundamentals? Did you know that professional market players can hide from you what they know, but can't hide what they do? Because you can see that on the chart. And in this webinar, you can become a behavioral finance guru and learn how to read the emotions and actions of market players. And you get to learn whether it's a potential start of a trend or too late to buy scenario. And then that will help you to make better trading decisions. And to guide us, we have Tom Yuen. He's a futures trader with extensive system-based trading and execution experience and a strong background in quantitative technical analysis. Tom's futures trading experience spans over 30 years, with the first 14 years spent as a floor or pit trader with the Singapore International Monetary Exchange, SIMEX, now known as SGX derivative trading, and he's a local. After the trading pit closed, after all that shouting from the trading pit, Tom was approached by SGX to assist the exchange in conducting formal trading courses. With more than 30 years of training and coaching experience, covering areas ranging from youth, leadership, risk and rewards of trading, technical analysis, money management, to financial literacy. He's one of the key mentors invited and endorsed by SGX-DT, who regularly conducts training classes for aspiring traders, as well as running seminars and webinars in Malaysia, Thailand. And he not only shares experiences with retail traders like you and I, but also to proprietary traders who are managing teams. And Tom, can I just do a sound check with you? Can you hear me? I reckon you can
Yes,
hear me loud and clear.
yes, I can.
All right, great, Tom. I can hear you as well. Members of the audience, I hope you can hear Tom loud and clear as well. If you can hear us, just type yes in the question box and I'll hand you to the good hands of Tom right
Testing, testing. Hope to see a couple of yeses in the comment box. No yeses coming in.
now. Well, let's see. They could be still having their dinner right now. So, Tom, if you're all set to go, we can get the ball rolling and kick off today's session. Oh, we have the
Okay.
yes coming. Thank you, BG. And thank you, Sia. Thank you so much. All right, Tom, over to you.
Okay. You do see a yes, huh? Actually, I don't see any.
You don't see a
Oh,
yes. I see a few yeses in the question box, actually, not the chat
it's a
box.
question. Okay, okay.
Yeah.
Sorry, that's a question box.
Yeah.
All right.
Yeah, members
Okay.
of the audience, just a heads up, at any point in time, if you have questions for the speaker, just type them down to the question box like what we are doing right now, and Tom will address them most likely after the webinar. So just type your questions in here. Okay? All right, Tom, over to you.
Okay. All right, once again, good evening to all of you. Thank you for being punctual. And some of you might be the first time seeing me. Some of you might have heard me before, whether during the physical seminar classes or in webinar over the last 2 years during COVID. This round, I have actually been talking to Philip, and I am doing a 3-part seminar of 1 hour each. If some of you know that I have actually done one last month, that is the first one. Today is the second one, and next month will be the third one. So if you miss the first one, don't worry. It is actually not important for you to do all the 3, but it would be nice if you have been following, yeah, and leading to the last one next month. All right, today's session, as you have heard from organizer, the title is Learn Behavioral Finance through the lens of a professional trader, through my lens, basically. All right, allow me to go through my standard introduction of myself so that people who are hearing me for the first time would get to know who I am. I come from the trading floor once upon a time, we call SIMEX, all right, after which it has been closed. So it is now under SGX, Derivative Trading Department. So some people, when they look at this picture, they will typically ask, so where are you? All right. If you zoom in, turn the camera around, you will see me. Of course, the one in the center is me. That is how I look like in 1994. Now, the proof that this is a still shot made in 1994 is the guy is standing next to me. All right. Not many of you would recognize him, but those who are more informed, yeah, and more knowledgeable, you ought to know that he is the man by the name of Nick Leeson, who single-handedly brought down bearings in 1995. All right. Now, I usually introduce myself this way by showing you this for two main purposes. Number one, the timeline to show you how long I've been a trader. I joined the floor in 1992, so you can count why they say that, or rather why I say that I've got 30 years of experience. And the other second reason is I want to show this guy not so much to put him down, all right, that he created a crisis, but actually this would lead to my next slide, which is again an essential important slide that is called the disclaimer. You must be very familiar with this. Yeah, different trainers talking about trading, they all have to show you this, and the typical tagline would be, "Oh, past performance doesn't guarantee futures performance," and so on and so forth. But I typically like to summarize all this in about 2 to 3 lines. First of all, the authority would like to warn you that what you're about to listen is considered high risk because you're talking about trading, we're talking about margin, leverage, derivative, futures. All right, this is often being perceived as high risk by most people, including the authority. But allow me to complement these two words with my own two words that is called high returns. Yeah. So basically, it is important for any professional traders who wish to achieve consistency, they got to be aware of these two aspects of high risk, high return. All right, they have to balance it very delicately. If you misbalance, what is the outcome? If you focus entirely on risk and you ignore return, you'll be so scared that you dare not make money. Yeah, you ignore the return if you focus too much on risk. But on the other hand, if you focus too much on return, wow, I can make a lot of money, and you ignore risk, then very soon you will be carried out in a stretcher. All right, so do not ignore any one of them. Yeah, in fact, later on I will talk a bit more about risk and return and the emotions that is associated with these two items. All right, one final one, whether it's going to be high risk or high return depends on you. It depends entirely on you. It does not depend on the market, it does not depends on the instrument, it does not depend on the authority or the trainer or the speaker, but entirely you. All right, so I hope everybody is okay with that, and that so far would be my intro. Now today, learning behavioral finance through the lens of me, yeah, Tom Yuen, YCK, I would like to put into perspective what I mean by that. Typically look at the blue words. Yeah, I like to make you understand that uh, using the analogy of music, if you wish to make music and you enjoy making good music, there are two important things. Number one, you need to have good musical instruments, without which you cannot produce music, right? The other important component is you need to understand at least basic music theory. Yeah, with an idea of basic music theory and with good instrument, combining them, you will be able to produce and make music. All right, so with this analogy, it's the same. Now in the black words, if you wish to make money in the financial market, you also require these two components. You need good instruments, yeah, trading instruments, and you also need to understand how the market behave. Today, I specifically borrow this term called behavioral finance, yeah, to explain about the generic market behavior. That is generic, right? Meaning that it would never deviate away from these general behavioral characteristics. Yeah. All right. So basically, as I mentioned, this is the second part of a 3-part series on be sharing today. All right, so let's take a look at what is behavioral finance, the
Hey
definition.
Tom, can you hear me?
Yeah, yes.
Hey, Tom, I think we lost your microphone for the last 3 to 5 minutes. Can you just jump back to what 2 slides back and cover that again? I'm so sorry,
Which
Tom.
one?
Yeah.
Which slide?
Uh, half we only heard half of making music, and then you
Oh,
continue forward.
okay.
Yeah.
You all
Yeah.
lost me. Now it's okay?
Yeah. For 3 to 5 minutes.
Okay. Is it okay now?
Yeah, it's good now, Tom.
Oh,
Members of the audience, rest assured, Tom will cover what he was sharing earlier. I think we lost you at to trade. You still need good trading instruments, similar to making music with good musical
oh,
instruments. Yeah, take us
okay.
from there.
Okay. All right. Sorry. Whichever the problem lies, hope to be able to continue. Yeah, with without any more disruption. All right. So don't worry if there's any more disruption. I'm sure Philip would be able to step in and rectify it again with me. So all right. Let me continue with that. So according to Sri, this is where my voice has been lost. So actually, I was trying to give the analogy using the blue words that represent music, that you need instrument and understand music theory, all right? And then in the same token, in black words, if you want to make money, you also need instrument and you need to understand how the market behave, yeah, in terms of equivalent of music theory, all right? So I was mentioning last month during the first part of this 3-part series, I actually covered instrument. I talk about futures options, DLC, whereby I talk about this. Now, if you miss that, actually doesn't matter. I think Philip has already put it up on the YouTube. You might be able to find it somewhere. But even if you miss that one, with whatever instrument that you are trading, yeah, it could be stock and shares or whatever, it doesn't matter. You can still use the same instrument and benefit from what I'm going to cover today, which is on the music theory itself in terms of behavioral finance, all right, which is this portion. So far, okay? So far, so good? All right. So let's take a look at the definition of what is behavioral finance. Yeah, it is very easy. You can type what is behavioral finance, and you can get all the Google definition, whether from Wikipedia, from Investopedia, or whatever. So basically, as you can see, it's a subfield of behavioral economics. Yeah, proposes that the keyword that would be there would be psychological influences and biases that affect the financial behaviors of investors or financial practitioners. Basically, they are talking about the psychological influences, all right? And this, let me go to the keyword. It will explain specifically market anomalies, all right, in the stock market, such as severe rises or severe crashes. Yeah. Now, of course, a lot of time when the market go up, right, go up or go down, most people would want to know why. And very often the explanation will be using fundamentals, yeah, things like okay, because of the Federal Reserve, because of the inflation, that they're going to have the rate hike, and then next moment they talk about earning report, next moment they talk about Ukraine crisis, yeah, that has affected supply and demand, and so on and so forth. Now, all these things, fine, they can explain, but there are very often where market would go up in a very ridiculous manner, all right, and market can go down and drop 90% in a very ridiculous manner that all the fundamentalists simply cannot explain through fundamentals. And that is where behavioral finance actually come in. Yeah, so behavioral finance actually does not only explain market anomalies, it also explain during normal market behavior why it is so. And I shall attempt to clarify this in today's webinar. All right, so let me summarize this in the next 3 lines, in the next slide with 3 lines. Number one, as far as I'm concerned, what is the reasons for the market to move, whether moving up or moving down? It is none other than the balance, or shall I say the imbalance of supply and demand. All right, more demand, it will push the market up. More supply, it would push the market down. I think everybody got to agree with this, right? Now, however, many people would like to use the excuses of fundamentals, of reasons, of news. Oh, because the news is good, therefore it go up. Oh, because the news is bad, therefore it go down. But very often there's some flaw to this, because I'm sure if you experience enough, very often you would experience, hey, how come good news and market still go down? Or how come very bad news and market still go up, right? I'm very sure you come across. And people without the understanding of what I'm about to say, they will say, hey, boli you leh, right? It doesn't make sense. Now, very often, the market movement does not make sense. Why? Because, as I mentioned, these are only excuses. A piece of news would be a piece of neutral news. Whether it's good or bad, it depends on interpretation. Yeah, the same news can be interpreted as good by someone. It can be interpreted by bad as by another one. So eventually, what happened? Whoever's size is bigger. All right. If the fellow who interpreted the news as good and he decides to buy with 100 lots, yeah, versus another one who think it is bad and he wants to sell with 10 lots, what is going to happen? 100 lots buying versus 10 lots selling, of course the market will not go down and it will go up instead. So that is my firm belief for my experience as a trader for 30 years. All right, so the first two lines eventually lead to the third line. The main underlying cause, yeah, or the forces would be none other than human emotions called greed and fear that will translate into supply and demand, that is causing the balance or imbalance that create market movement. Right, I hope this definition is okay with everyone, that I derive this summary, three-line summary, from the definition of behavioral finance. All right, so how does the market generally behave? Yeah, now the market alternates between two modes between trending and non-trending. Again, using my three lines definition, is very simple. When the supply and demand is actually balanced, when it's balanced, right, no one is able to push the market higher nor lower, so it will fluctuate around a certain fair value range. Yeah, sometimes this range can be narrow, sometimes can be a little bit wider, but nevertheless it is in a balanced fair value range until a point in time whereby the supply and demand will go off balance. It will surely happen. So once it's off balance, it depends on off balancing in which manner. If it's off balance such that there are more buyers than sellers, it would go up. Conversely, if there are more sellers than buyers, then it would go down. So in other words, what you need to remember for now is how the market behave. It will alternate between trend and non-trend, meaning that the market will trend, but it will not be able to trend forever. Once it reaches equilibrium, yeah, in terms of supply and demand, it will go into a non-trend, which is sideways. It will go sideways, and it will not stay sideways forever, because eventually there will be a tilt in supply and demand that will cause it to trend. So it will toggle between trend and then rest and then resume trend, and trend and then rest within and then resume trend. All right, it's important for you to remember this. Yeah, okay, so if you're okay with this, we go on to the next step. I would typically like to show the example of the market from 2007 uptrend, all right, into 200, or rather 03, 04, 05, 06, 07 into a 08 crash. Yeah, now so you can see this is 06, the market uptrend, right, whereby there is still a imbalance. So it will reach a certain point whereby the balance will start to reach equilibrium. Yeah, then it will go into a big sideway. Can you see? This is a sideway that lasted for 1 year. And within this big sideway range, there will be minor trend up, down, up, down, up, down within the big sideway range. Eventually, from this sideway, right, what happened? It will either continue to trend up or down, all right? And then that is when it lead to the 2008 crash, whereby there are more selling than buying that caused this market to go down. Now, the market will not be able to trend forever, and once it reach equilibrium, it will go into a sideway again, right? After this sideway, which eventually it form a base and it resume its uptrend after the '08 crash. Yeah, so this is a chart illustration to basically show you what I mean by toggling between trend and non-trend. All right. So now, if someone were to say, so Tom, how do you exactly tell, all right, whether it's trending or non-trending? Although it's quite clear from the market movement, but we want a more objective manner to give us a more definite definition of whether it is trending or non-trending, all right? That is when I will apply something which I call analyse. Yeah. Now analyse are actually 17 moving averages. I'll talk about that later on. But right now, this analyse, right, is how it looks like. Okay, these 17 moving averages is what I call analyse. Now, so you will look at the analyse, yeah, because there's 17 of them. They would either squeeze or they will open up like a fan, right? So very simple. When you see that the analyse are in the opening up manner, that is when the market is trending. Yeah. No. So either this arrow, this left right arrow, is to show you either you feel that the market is trending, you should be seeing the analyze opening. Or if you do not know whether it's trending or not, you see the analyze opening, that means it is trending. All right. And then, as I said, the first thing is it will toggle between trend and non-trend. So it cannot open forever. After opening wide enough, it will have to squeeze. So this squeezing portion is when the market would go into a non-trend manner. All right. So that is how you tell, yeah, by looking at the emo lines. Now, so you take a look with the same chart from '07 to '08 to '09. All right. So you can see that the emo lines from squeeze to opening up. Yeah. This is the opening up portion whereby it is trending. And when it opens a lot already, right, you know that it cannot trend forever, so it has to go into a squeezing mode. Yeah. So this is the part that it attempt to squeeze. This is the part that it attempt to squeeze. All right. So it squeezed already until this portion. So after squeezing for a while, it's going to have to open again, right? So this is the portion that is opening, and that is when it is trending downwards. Yeah. Once it opens very wide, you know that again it cannot continue trending forever, so it has to go back to squeezing the emo lines, whereby this is the portion that it is squeezing and it is going into a sideways mode. So that is how you tell. Pretty simple. Emo lines opening and squeezing to tell you whether it is toggling from trend to sideways or sideways to trend. All right. Okay. Behavioral finance. Yeah. When is behavior normal and when is behavior considered wrong, can go wrong? That is when we talk about emotions, whether is it moderate emotion or whether has the emotion gone extreme. For now, we can apply this to everything in life. Yeah. For now, let's talk about general, not limited to trading. Now, in our normal day life, I think there's one particular emotion that will affect a lot of people, that is called anger, right? Anger. I'm sure some of you are very angry people. Some of you, you do self-reflection, or if you are not, right, I'm sure among our circle of friends and family, you must have people who typically have got anger control issues, they're always angry, right? A lot of times when things happen that is not according to our expectation, we will get angry, right? It is okay to get angry as long as it is moderated. Yeah. Moderate emotions are always okay. So moderate anger, is it okay? Yes. You are trying to convey a message that I'm not happy. Yeah. So you either change or whatever. All right. Okay. However, some people do not allow their anger to just stay moderated, and they simply enjoy going beyond moderated emotion, and they allow themselves to go into extreme anger. Whatever emotion that go extreme would become bad, and you can potentially turn out to be very, very wrong, right? For example, I'm sure all of you know, very angry, you would say things that you don't mean it. Yeah. At the end of it, after that, things are already said and done, cannot unwind already, right? So if moderate anger is okay, but extreme anger is never okay. So this slide, I hope it will also help you, not only in trading, but in managing your normal day life. Talk to your family members, talk to people. Angry, okay, but don't get angry until you say things that you don't mean it, then the damage cannot be undone. All right. Okay, so that is to illustrate moderate and normal. Now, how about in the market? In the market, there would be these two emotions called greed and fear, which I mentioned earlier. Yeah, a very common emotion that you see manifesting every day in full force and full energy. When I was new, 30 years ago, I attended some seminar, right? Some talks. I remember at that point in time, a lot of speakers, yeah, always try to tell people that, oh, to become an investor, especially as a trader, you must trade without emotion. All right. Now, I studied in university. Yeah, I studied com science. I minor in a subject called psychology. Not minor lah. It's part of my com science package that I study psychology. Yeah, so I'm very interested in psychology, and because of that, when I hear these people talking about you should trade without emotion, I totally cannot agree. Yeah, as far as I'm concerned, living being, we must have emotions. There's only one kind of people that's got no emotions. That is called dead people. Si liao, right? Only dead people have got no emotion. When you're alive, you will have emotions. Yeah. Now, to me, not only we have emotions, in fact, greed and fear is very important. Greed will provide you with the necessary motivation, whereas fear would provide you with the necessary precaution. All right. Without that, you are either non-motivated or you are not careful. So to me, it's very important. All right. Now, however, you have to make sure that your greed, yeah, is moderated and your fear is moderated. When they are not moderated and they go extreme, what happens? Extreme greed will become euphoria. Same thing, extreme fear will become panic. So for now, remember this four term: fear, greed, and fear. Extreme greed is called euphoria, extreme fear is called panic. All right. So these are the four emotions that we want to take note when market is displaying them. So how do we identify these four emotions in the market itself? Now I'm simplifying this model to make it understand. It's very easy. Let's talk about this again. Let's go back to talk about market. We'll toggle between trend and non-trend, correct? And that will cause the emo lines to squeeze and open. Now, when the market going sideways, that is when the emo lines are squeezed. Or if you do not know, you look at those period, those areas where the emo lines are squeezed, right? Market is in a rather sideways mode, meaning that the supply and demand are rather balanced. Yeah. So look, this is a squeeze portion, this is a squeeze portion. Okay. Now, from squeeze portion, eventually what happened? Eventually the market will cannot stay in a rest mode. It will have to transit into trend. Now the question is it going to trend up or is it going to trend down, right? So some people might say depends on the news. Again, I won't say depends on the news. It depends on how the people interpret the news. If majority of the people interpreted the news to be favorable, that would trigger their greed and they would come in with a stronger buying force. Yeah, and that would topple the balance, right? More buying will push the price up. And this pushing the price up will cause the emo lines to open to the upside. So this is called squeeze opening up. I repeat, squeeze opening up. So when you see emo lines from squeeze opening up, you must, this word must come to your mind. Oh, I see greed. Yeah. Now, conversely, if the emo lines are squeezed, where market is in a bit of sideways, trying to decide whether up or down, and if at that point in time, the general market interpreted the news to be unfavorable, and they start by dumping, yeah, by selling. By selling already, it will push the price down, and you see the emo lines from squeeze, it will open down. So let me repeat: squeeze open up is called greed. Squeeze opening down is called fear. Okay, so I hope at this point in time you are able to identify where is greed and where is fear. Now, on the other hand, look at the portion where the emo lines are already open wide. All right, if after today's session, you go back and you look at the chart, you have a chart, and you look at whatever contract that you are trading, yeah. If you see that the emo lines have opened very wide, either the top side or the bottom side, and you have not participated, very sad law. That means you have already missed the entire trend. Do you know that? All right. Under what circumstance would the emo lines open wide? That the market would have started trending and have trended quite substantially. So from squeeze, it opens, right? It will trend and it will open the emo lines until when it is rather wide. When the emo lines are wide and price is on top, that is when I call euphoria. Yeah, that part euphoria already. Why? Because really, at that point in time, you will see that a lot of people would have missed this move. The emotion will be very high. They will feel very picture. Yeah, they will see people making that kind of money, and they were like wish to get in. People who have bought already happy with the money and listen to the forecast that it will go higher. Yeah, just like Bitcoin. Yeah, going to 60,000. People think that, oh, it's going to go to the 200,000, right? So people will get euphoria. Now, when emo lines are wide and price is on top, that is called euphoria. Conversely, when emo lines are very wide and price is below, which means that the market has already dropped a lot. Okay, so this I would have explained to you these 4 emotions and how to identify them. I hope it's okay. We see one more time. This is to see squeeze, open, upside, greed, squeeze, open, downside, fear. This would be immobilize, open, very wide, price on top, that is euphoria. Immobilize, open, very wide, price below, that is called panic. Okay, all right. So having identified the 4 emotions, there are corresponding actions, yeah, which is called SOP. Now, so professional traders, very often we follow SOP, just like fighting a war, right? There's certain procedures to follow. So what are the SOP? Very simple. When you identify greed, go long. When you identify fear, go short. Yeah, very simple. When you see the market is euphoria, SOP is too late to buy already. Okay, when you see the emotion is panic, SOP, too late to sell already. All right, now before you have any question, just remember this mantra first, yeah, which is not very difficult. Greed, long; fear, short; euphoria, too late to buy; panic, too late to sell. Okay, all right. Now I summarize this in the same chart, yeah, using colors. Now, green color would suggest buy, red color would suggest sell or short, blue color is to suggest uncertain. Blue color portion is something that is beyond the scope of a 1 hour discussion. All right. Now, where I say euphoria, the immobilized open wide price is on top, too late to buy. You can still buy, but you know that you have already missed a whole move already. Your risk reward will no longer be good if you were to buy at this height. Yeah. At the same time, euphoria, do you want to sell? Well, you make sure you know how to pick top professionally. If not, you are going against trend. And that is the reason why I use the term too late to buy, right? I did not say cannot buy, neither did I say must sell. So it all depends on your competency, your skill set, whether you have additional knowledge to know what to do at this level. So same thing, when the market has dropped a lot already, this is too late to sell. Okay, if you did not sell earlier, don't try to dump over here. Yeah, it's too late already. But yet, to be able to effectively, professionally pick the bottom, that requires skill. Yeah, that is a bit beyond today's 1 hour session. So therefore, this is a summary slide of my topic today on how to identify greed and what to do. Greed, buy; how to identify fear, short; euphoria, too late to buy; panic, too late to sell. Okay, so now further breakdown into the characteristics. Yeah, the green box is the buy, the red box is the sell, the euphoria and panic is the blue box. Yeah, that is a bit not so clear as to what to do. So if you think you are rather new, yeah, so Tom, what should I do? You focus on what is clear. Focus on greed, because greed is when emotion is moderate. When most people emotions are moderate, what they do would likely to be correct. Yeah, same thing. Fear is also a moderated emotion. So at this juncture, follow what the general public is doing. All right. Now, so you say, if you say, hey, so Tom, greed buy idea, sure to make or not? Look at this carefully. Greed does not guarantee the start of trend, but the uptrend would always start with greed. All right. Market goes sideways, immobilize squeeze. If it start to go up, it will start with a sideways squeeze and open up, which means that if you identify a greed setup, out of 10 times, assuming 5 times you are wrong and 5 times you are correct, yeah, half, half, half. So if sideways, you see greed, you buy. If you are wrong, well, I don't know about you, but professional traders, when we buy and we are wrong, we cut loss. All right. When market is in the sideways range and you buy already, you cut loss, our losses will not be a lot. Now, the other 5 times, when indeed it trend, we buy and we get in at the start of trend. So if you do 10 trades, you are wrong 5 times, it didn't move, fine. We lose a little bit 5 times. And the other 5 times when it actually trend, we would be making money on a trend the other 5 times. All right. So conversely, yeah, if you see fear, if you see the market immobilize squeeze and start to open the downside, displaying fear, right? We want to sell. Now, fear, when you identify the setup, it does not guarantee a start of a downtrend. Yeah, but a downtrend would almost always start with fear. So from sideways, it start to trade lower. Yeah, and then eventually lead to a ultimate crash. Again, if you identify 10 times, right, this fear setup, and you get 5 times right, 5 times wrong. Again, when you sell and it doesn't go down, come back up, we cut loss. So I cut loss on 5 of my trades, yeah, losing that bit, but the other 5 times I catch the waterfall. So net, we will make money this way. All right. So, okay. Now the interesting thing is, take a look at Euphoria and Panic. Yeah, I've got a little bit more to share with you on these two conditions of market behavior. Now, Euphoria, once the immobilized open wide, that means market will have trended quite a bit. All right. I talk about one side, the other one is the mirror image. So I talk about Euphoria. When after the market trended quite a bit with immobilized open wide, you would start to expect volatility to increase. It will surely increase because at that level, there will be people who come in to still chase, the FOMO one, fear of missing out. They will chase and they regret they didn't buy earlier, they didn't buy at all, so they buy at the high. But at the same time, some people will try to pick top, right? And they will sell here. And it will start to, at certain point, start to have a fight that would create increased volatility. Yeah. Now, when the market start to increase in volatility and after moving up so much, there'll be a lot of news trying to explain why, right? Why is it that high? There are a lot of people trying to forecast, no, it will crash again, no, it will go up some more. And all this will cause emotion to be high. Once emotion will go up, common sense will become low. All right, and that is the problem. Now, I'm going to talk a bit about what I mean by common sense low. Yeah, is related to emotion. Common sense low. What has common sense got to do with trading? Okay, there is a mathematical formula that shows emotions connect to common sense. All right, let me share a little bit of a trivial story. A long time ago, I watched this movie by Jack Neo called Xiao Hai Pu Pen. I'm not stupid. I don't know whether you all remember or not. All right, I remember they talk about EM1, EM2, EM3. Yeah, so these three children, they are from the bad class, so to speak. All right, and therefore one of them is always being harassed by the parents. The mother will always scold him, right? Use your common sense, then use your common sense, use your common sense. One day he really can't take it. He retaliated and he told the mother, but mommy, all this while you have never taught me how to use common sense, right? Now, have you been scolded? Use your common sense when you are a child by parents, by teacher. Right now, if you are a parent or adult, do you scold other people use your common sense? If you do, please stop. Feel ashamed for yourself. All right. Do you know how to use common sense or not? Honestly, I do not know the various reasons you decide to attend this particular webinar of mine. This slide itself, I'm going to teach you something beyond trading. All right. I recently saw a slide, very interesting. Saw a quote. Yeah, it goes something like that. They say that nowadays, common sense is so uncommon that it should be considered a superpower. I don't know whether you find it funny or not. I find it very funny. Yeah? Let me repeat. Nowadays, common sense is so uncommon that it should be considered a superpower. All right. Now, let me share with you something that I learned a few years ago with a discussion with someone very wise. Yeah. He said it's very easy. Common sense is inversely proportional to emotion. When your emotion is higher, right? Angry, very happy, very greedy, deeply in love, right? Emotion high, your common sense is low. You'll be blinded. You cannot see and think properly. If you want your common sense to be high, you make sure you maintain your emotions low. That is why people do meditation, people try to stay zen. That is the purpose. If you can control emotion through all this meditation and practice, then your common sense would be very sharp, would be very high. So it's actually very simple. Now, and most people come into the financial market to do what? To make money. Whether they make money or they lose money, it will stir their emotions to be high. And when the emotion is high, naturally common sense is low lah. Therefore, continue to lose a lot of money, right? And go and ask why. All right. So therefore, this is what I mean. Again, when the market move up after trending, immobilized open wide, expect volatility to increase. When it increase, there will be more news, more thing to stir your emotion to be high. That is when your common sense will be low. All right. And then the SOP is market would be there to form a reversal pattern. Will reverse or not is another story, right? Double top, head and shoulder, triple top, all those things will start to form. Okay, so conversely, panic is the same. When the market drop, wow, people tell you declare bear market already. You see the YouTube bombarded with all the trainers. Half of them will tell you it's going to crash. Half of them will tell you no, it's a good time to buy, right? Who to believe? Hey, who asked you to believe in anyone? Right? Don't believe in anybody. Try to understand the market behavior yourself. So when the market goes into a panic mode after immobilize open, expect volatility to increase. Yeah. And that is when you have all kind of news bombarding you to cause your emotion to be high. And that is when, if you allow yourself your emotion to be high, common sense would be low. Common sense low, make mistake. That is what would happen to a lot of people at market top and market bottom, right? So if you understand this, you will know how to prevent it. Follow SOP, buy at greed, here too late to buy. Sell at fear, panic, too late to sell. Yeah. So therefore, just ask yourself this question when you choose a product to trade or invest. You look at the emo lines. Are the emo lines squeezing or opening, right? To tell you whether it's trending or transiting into a sideway, or sideway transiting into trend. Now, then is it opening up or opening down, right? So opening up, greed, you long. If opening down, fear, you short. If it is opening wide already, expect increased volatility, expect emotion to be high, expect common sense to be low. The rest of the common sense low people would make mistake. As long as you do not make mistake, money would transfer from their account to your account. It's that simple. All right. So by this time, some people will ask, so Tom, what are those emo lines, right? I mentioned earlier already, they are moving averages. EMA, exponential moving averages. Later, don't ask me, can use SMA or not. SMA will not give you such nice opening of the fan effect. Use EMA, exponential moving average. Parameter, 3 times stable. 3 times stable, 3, 6, 9, 12, 15, 18. Start with 6, right? I use 6, 9, 12, all the way 17 lines, yeah? Now, and these are my color This is just a reference a guide for you to see my color scheme. You can choose other colors if you want to, and if there's any special parameter that you like yourself, you can also plan it into this set, yeah, to pay special attention to your own parameter. Otherwise, this will allow you to see the effect of opening and squeezing. Okay, EMAs. All right, so I have basically covered what I wish to share with you today on behavioral finance, yeah, using this emo lines. Let's do a quick recap. Let's do a quick recap. I can't actually see your comments. I've clicked on the questions box already. So if you like to, you can type in. I see whether I can see the answer or not. Now, instead of you just listening to me, let's recap, right? If you think you like it, do you remember? Using emo lines actually, over the last half an hour or so, what have I been trying to help you understand? You can type or you can think. I don't want to feed you with the answer first. We do a recap. All right. Okay. Now, answer is I've been trying to make you understand the market theory, how the market behave. There is actually certain order one. Yeah, it's not totally random. Correct. So, how does the market behave generally? Can you recall? How does the market behave? All right. First clue: the market alternates between two modes. Do you get that right? It will toggle between sideways. It cannot go sideways forever. Eventually, it has to trend. Yeah, it cannot trend forever. After running for a while, when balance becomes equilibrium, it will go into sideways. So it will toggle between sideways to trend, trend to sideways, sideways to trend, trend to sideways. 永恒不变, always like that. All right, then, so how do I tell? How do you tell? You use immobilize. Objectively, once you plug the immobilize into your chart, you can see the visual effect of the immobilize squeezing, means the tendency of going into sideways. After it has squeezed for a while, you know that from sideways, it is going to have to trend. All right. Then it opens, that is when it's starting to toggle into a trending mode. Yeah. After trending for a long time, you can expect the immobilize to want to squeeze. And that is when the market will have to switch into a sideways again. All right, so how to recognize the 4 emotions? I'll let me recap a bit. Is this easy? I think this is easy, right? So market, the immobilized squeeze, open, up, that is called greed. Yeah. The immobilized squeeze, open, down, that is called fear. When the immobilized open very wide, price on top, that is euphoria. When the immobilized open very wide, price is below, that is panic. All right. That is how you recognize the 4 emotions. And what are the SOP to the 4 emotions? Greed, buy. Fear, sell, because they are moderate emotion and people tend to not make mistake, yeah, when they become greedy and fearful at this stage. But when the market become euphoria is extreme greed. All right, SOP, too late to buy already, right? Panic, SOP, too late to sell already. Okay, so what are the characteristics? Yeah, greed buy, fear sell. You do this over the long run, you would surely make money. There will be losing trade, but you will make more than you lose. However, when the market go into euphoric stage or panic stage, is more tricky. Yeah. When the market reaches this stage, first of all, expect volatility to increase. All right. Volatility increase, then people start to ask already, what up or down, up or down, up or down. You realize that at the end, hey, it's not up or down, it's just going into big volatility to stir emotion, emotion high, common sense low. All right, that is when market would form a big top formation or a big bottom formation. Can and finally, how can you benefit from understanding this, or how do you benefit from understanding this? I hope you have the answer for yourself. Okay, I'm not going to provide you the answer. If you can ask me, so how do I benefit? Then cannot make it already lah. All right, I have already explained to you generally how the market behave. Yeah, in the past, in the present, in the future, there's something that would never change: human emotion. So if you see from this perspective and how this human emotion, greed and fear would stir the market to its perpetual fluctuation and knowing what to do at each stage, that is when, provided you control your own emotion. All right. So this is the ultimate summary, yeah, of the technicality of behavioral finance, going into identifying the various stages plus the SOP involved. And now let's take a look, all right, that you sign up for this webinar. By reading all this, have you ever wondered why people tend to buy at market high or sell at market low? All right, I've given you a reason. Now, I'm not saying that this is the only reason, yeah. FOMO lah, people, wow, fear of missing out. They miss earlier and they chase at the high, and then at the low, BTH, right, stands for buay tahan lah, and they dump. So that is when emotion reaches the extreme, greed and fear that cause people to do that. Now, do you sometimes find it difficult to follow news or analyze the market fundamentals? I don't follow news. I don't analyze market fundamentals. Basically, I want to listen to the news and I want to interpret how other people would interpret this news. All right. First of all, whatever news that come out, I will have to, I basically, my first thing is this generally considered good news or bad news? Yeah, by majority. If it's the good news, market go up. Bad news, market go down. There's nothing special. But if good news and market go down, or bad news and market go up, this is very important information, very useful information. All right, we will follow price action. We won't follow news. Yeah. So finally, how you potentially spot a start of trend. When is it too late to buy or when is it too late to sell? Okay, now all this write up for this webinar, I've already explained and discussed with you. So finally, this is my agenda, yeah, from introduction to separating market instrument and understanding market behavior, to behavioral finance, to understanding market structure, to recap. And let's take a look. All right, take a look at what is happening now to two markets, yeah, just randomly lah. Now I am doing courses for SGX that focus on trading SIMSKI, which is the Singapore market. And something that a lot of people have been trading since the COVID crash that has come up a lot would be the tech stock. So typically, I would just use NASDAQ and the STI to show you the analyse, all right, with two markets. Now, this is NASDAQ. So look at the market with the lens of analyse, all right? So you can see how when the analyse squeezing the time, as the price push upward, the emotion is called greed. All right, greed is to buy. Now the market go into a uptrend, higher high, higher low, right? And then it goes all the way up. Without this portion, actually the market over here, immobilize already opened quite a bit. You have to take note that it's a little bit too late to buy already. When the market after trending quite a bit. All right. Now, at the same time, over here, it is being triggered by the COVID, right? The COVID outbreak that caused this to plunge. Yeah. So it is not only a correction, not only a higher high, higher low correction, but it plunged to the other side. Very quickly, the US government came in to do whatever necessary support. Yeah. So all these reason being interpreted by the players, what they do, their action will be reflected in the chart. And very quickly, something that I wouldn't have the time to cover today, that is price action. All right, either candlestick or you talk about candles open, high, low, close. Yeah, so the market from here did a V shape. Very quickly it resurfaced back above the immobilize, and over here you can see that the immobilize do a bit of squeeze and they start to open into greed yet again. All right, yet again. Now technical traders, we will focus on looking at the SOP. Whereas I know a lot of men on the street, they start to analyze the effect of the COVID, they start to analyze the lockdown, they start to analyze the economy is going to be bad and a lot of companies going to die or whatever. Yeah, so they did not buy. But whoever trader that follow SOP, greed will basically just buy. Now, this whole thing lasted all the way until the beginning of this year, 2022. All right, so that after a prolonged move here, that any time when it is too much away from at the higher of a big open immobilize, is too late to buy. All right. So when too late to buy, it would do a bit of retracement, retracement, and finally over here. Okay, the fundamentals have taken a shift. Yeah, of course, the shift is because of the inflation, because of the Fed deciding to do a rate hike or whatever. Now, all these are news, but what we want to see is how are these news being converted into price action. All right, so the market at that point in time really start to do a deleveraging, because most people, when the government policy is to have what they call it is to have all the quantitative easing, right? Is to allow borrowing. So they borrow heavily and they invested into tech sector, and that allowed the Nasdaq to rise all the way. And when this easing start to go the other way, tapering, now the unwinding with price action start to eventually, the market cannot trend all the way, so the immobilize is going to have to squeeze, right? It go into a squeezing process. Now over here, can you see the same thing? Squeezing until over here with price action, it start to give you opening into fear. So that give you a drop of about 2 months, right? And then just about 1 month ago, all the big hoo-ha, all right, about CPI lah, about whatever lah, about rates lah, but immobilize, relatively speaking, open rather wide, too late to sell, expect increase in volatility. Just follow the procedure as per I've explained to you guys. So this is Nasdaq, and this is the current situation. I captured this over the weekend. Now the other chart I want to show you would be our market, STI. All right, quite the same. STI is not so trendy. We are very much in a sideway mode. So the immobilize squeeze, right? Same thing. When it starts to open into fear, it corresponds with the COVID plunge. And when it runs away from the immobilize that is open very wide, if you can understand price action, too late to sell, and you need price action to tell you how to buy. All right. Now, after this, after opening for a while, time to squeeze. When it squeeze, right, it turned to the other side and flip into greed. That is how our STI started to catch up with the rest of the market and start to move up. All right. And then, just like everybody else, until the beginning of the year, when Immunize opened relatively big, too late to buy at the top, and we are going into a sideways mode. We are actually not going into a bearish market. Yeah. Whereas the Immunize actually squeezing, we are doing a very narrow sideways range. Many people, stock investors, they attend my seminar before COVID. During COVID, attend my webinar. They will say, Tom, why you look at our market? Yeah, it's not moving. Hey, investors don't like sideways market. Traders can benefit a lot from sideways market. Sideways range, identify the low and the high. We just buy low, sell high, buy low, buy. If you give me a 10 years of sideways market, I have no complaint. Only investors will complain. All right. Our market is very good to do sideways trading. Yeah. Now, so this is the situation of STI. Okay. Just example. More examples, you go back and see whatever market you are trading, you plot the emo lines and you do your own case study, yeah, and understand how it behaves. So a few quotes. Ed Sikoda, whether you heard of him or not, the trend is your friend, except at the end when it bends. I hope you have a better understanding of this quote now. The trend is your friend. When you see greed or you see fear, it suggests the start of trend. It is your friend. Please join. Except at the end when it bends. How do I know when it is going to end? When the emo lines open very wide, don't hope too much already. Yeah, you can take profit, you take profit. You might not catch the dip or the high or the low, but you have already ridden the bulk of the trend. All right, that is Esikoda's quote. Now, Paul Tudor Jones, he said something else. I believe the very best money is made at market turns. Now, he is someone that like to catch the top and the bottom. So obviously, how can you do that? Well, you need to develop your skill to look for emo lines to open wide, euphoria, find setups, yeah, to catch top, or when emo lines open very wide at panic, learn setups to catch bottom. So actually, the emo lines itself, I can use it to explain what S. Sikora say. I can also use it to explain what Paul Tudor Jones says. All right. Okay, what I've shared with you is not meant to be understood intellectually, but to be experienced. I always say this, trading is not an academic pursuit. Don't come and talk to me about academic and try to justify, quantify, and argue. There's no need to argue. Every day we're arguing with two things. We're arguing with the market. Sometimes we have to argue with ourselves. Yeah. So therefore, you have to throw away the intellectual portion, throw away the academic portion, try to feel with your heart. So basically, this is the next slide that I want to prove to you that it's not an intellectual thing, because in 1993 there's a newspaper article that actually show the statistics of floor traders income. University degree holder make the least money, right? It's those educated lower one that they are the one that know how to play this market well, because they don't think too much. Yeah, they learn how to feel the market and they learn how to estimate the risk with their heart, not in the academic manner. All right. So therefore, it's all about my method, money management. And if I were to summarize everything that I've said today with one slide, I will quote something from 孙子兵法. 知己知彼，百战百胜. Know thyself, know thy enemy, 1,000 battles, 1,000 victories. Many people try to attend the course and try to learn everything and try to challenge the trainer about a perfect setup. But a lot of people don't know that they need to look inwards to also know themselves. Make sure your greed is moderated. Make sure your fear is moderated, right? What is worse is I can teach you how to identify the market, but you yourself, yeah, always behave in a euphoric manner, in a panic manner, you're sure to lose money. All right. So I hope you can take home this summary slide to basically wrap up everything that I've shared with you today. Okay. So good instruments, good understand how the market behave. Yeah, of course, asset classes. Yeah, you can trade forex, you can trade whatever. That one is a different discussion. They have different characteristics as well. All right, so that would be today's topic on this. Yeah, now allow me the final couple of minutes to just talk about. So if you wish to trade, therefore, so Tom, okay, I think I want to experiment this, right? How can I do so? If you already have an account with Philip, well, do so. If not, open an account with Philip and get them to support you on the instrument that you want to know, like futures, yeah, like how to execute the interface, like how to play around with their charting if you do not have. Now, other than that, professional trading, yeah, requires developing a trading plan. We need to learn setups. We need to learn a lot more details, more than what I've just shared with you over the last 1 hour. And this is what I do. I trade index futures with technical analysis. All right. And I have a website. You can visit my website. Uh, I'm not the only trader or trainer there. I have another sniper trader who is a world-class trader. She trains students that are able to make 7-digit income in a month. You didn't hear wrongly. I say correctly. 7-digit income in a month. All right. So therefore, you can go and read our blog. Some of the things she write. This our blog, and yeah, I also do training for SGX. Allow me to share very quickly. If you wish to join my course to learn more, where and how do you sign up? Now you can scan this QR code. Basically, it's the SGX Academy lah. SGX Academy. I have only one course left for this year. The scheduled date is September 3rd and the 10th, yeah, on 2 Saturdays, full day, yeah. And the price is $2,000, but there's a heavy IBF funding. So if you are 40 years old and older, it will be 90% funding. So you pay only $200, all right? However, if you are younger than 40 years old, then it will be 70% funding. So this is my last course for this year. If you really want to, don't miss this, yeah. Now you can attend my 2 previews organized by SGX Academy to talk about this. So take note, it's on the 2nd and the 18th of August, whereby I will talk more about my course, yeah. Now this one is actually very similar to today's session, so you might want to attend this one. But if you wish to sign up, don't wait till after this to sign up, because the places are limited. So once it is full, then no more chance for you this year. All right. Okay, I have 3 parts with Philip. My next event date is on the 30th August with Philip again. I would, in this session, talk about how to find a trading advantage, yeah, and I would give you some practical example, specifically using SIMEX, okay, as an example. So if you wish to catch my 3rd part of this 3-part program, take note of the 30th of August on a Tuesday, back with Philip, just like today. All right, so I'm done. I think my timing there about 8:03. I do not know how much time we have for Q&A. So, organizer, back to you.
Thank you so much, Tom, for walking us through the insights. I think today was quite a interesting session. I learned so much myself, and I believe the members of the audience would have as well. Shall we take some time to look at the questions? Tom, do you see the questions on your end? We have some very good questions. Would you like to pick out 2 or 3 questions and address them very quickly? And then the rest, we can pick them up in the follow-up email that we'll send today.
Let me see. I'm not able to see the questions left.
Okay.
Sorry. Okay, do that.
Okay. Maybe the first one is from DG. He's asking Tom, what do you see in the charts on the current market, SDI, S&P 500 situation now, midst of the bear market and more to come? Moving averages are all pointing down to.
Wow, if I'm a little bit direct to answer your question, I hope you don't mind. If I have gone through this whole session with you, this question doesn't reflect very good understanding. All right. First of all, listen carefully.
Tom, this
I
question came early on. So this
Oh,
was a
I see.
question probably submitted earlier.
Okay, then I forgive you. Now, let me share something with you. I am a trader, I'm not an analyst. In our course, we are teaching our students. In fact, I say, I pity investors. Investors very putting on. They have to go around and listen to a lot of analysts and all the gurus giving different advice, right? And they got to be right. Because investment is long term. Yeah. Imagine if you don't get it right, you would have wasted like 1 year. Yeah. How many 1 years do we have? But as traders, we have an absolute advantage because we do not have to be right, and we are trading very short term. So once we learn certain setup, we go into very, very short term and we look for those setups. All right. If we are wrong, there's always another setup the next day or the next week. So therefore, this question come earlier, fine, because at this current state, everybody want to ask everybody, like what I mentioned earlier in the YouTube, you have 10 people, five of you, five telling that market is going to crash, the other five tell you that it's a good time to buy, right? You're all confused. Don't ask me what, because I'll tell you I don't know. I don't know. I don't have to know. When the market came down low enough, all right, now to ask me what's low enough lah, again you need additional thing to suggest to you that when it is low enough and it's not going down, use price action to watch for market not going down. If the market is not going down, it will have to rotate upwards. All right. So if we are correct about this, we will go in with a decent size to catch a small rotation upwards, right? And then we put money in our account and we will wait for the next setup and the next opportunity. So that is what we do. And therefore, in all my seminar over the last more than 10 years with SGX, whenever I come to question on people asking me about direction, I don't give direction. Not because I'm afraid that I'm wrong. In fact, I tell you, I can be wrong a lot of times, but it's not important as long as I make money short term. All right. So come back again to this question. Go back and plug in the emo lines, on your chart, and I hope you have a bit of knowledge of price action lah. Like for example, candlesticks, or even bar chart, open, high, low, close. If you combine them, then you will be able to tell when it's too late to sell, right? When can you attempt to buy? Once the market pull back, pull back, and then you see selling price action. That is when you want to be careful. Eventually, I do not know whether it's going to go up or it's going to go down, but looking at the current market fundamentals, chances of it going up is low, because first of all, go back. I want to go back to this slide. Organizer, sorry, allow me to elaborate a little bit more on this. All right, you see, so basically, the reasons for market movement, right now, the Federal Reserve, in order to combat inflation, they have a plan to increase interest rate to a certain amount, and they plan to reach this amount towards the end of the year. Next year, what happened, we do not know yet. All right. So therefore, this is one reason that interest rate will continue to rise, which will not be in favor of the market in general. The second reason, during the COVID, they are doing a lot of money printing, and now they are reversing the process. They are doing tapering, so that when they're doing tapering, that means money available to circulate in the market is also reduced. So that in a way would limit the demand. So because of that, I would conclude that the bullish upside chances would be low. So it is either a sideway at this level, to form sideway range, and eventually any panic, it might give you another flush down. How it will happen, I don't know, but these are the two more likely scenario. Come till end of the year, then I will have to analyze again what will happen next year, right? I don't need to look so long term. Hope the answer will be okay.
Yeah, sounds good, Tom. Thank you. The next question is, do you look at daily or weekly charts for your emo ones?
Both.
This is a question that came in slightly earlier as well, around 7:55. So maybe you wanna touch on it to just refresh everyone.
Okay, both. First of all, the most important time frame to do analysis is actually daily, because a lot of people look at daily chart. Not that we want to follow people. I want to see what they see, right? After seeing already, they take action. It will reflect on the daily price action. So that would let me see whether collectively there are more buying or more selling. All right. So daily is definitely the main frame. However, there are times when daily is like not very clear, or I want to see what is the bigger picture which is just like you look at the river, look at the river on top, right? But you want to know below the river, where is the current pushing? That is when I also reference the weekly. So let me just give you the mantra. The difference between daily and weekly. Daily will react faster, yeah. Weekly would react slower, but a weekly trend would be more powerful than a daily trend. All right, I repeat, a daily will react faster, but I also want to see the weekly, because although a weekly is slower, but when the weekly trend develops, it is more powerful than the daily trend. So I look at both for slightly different purpose.
Hey Tom, just wondering, does the emo lines work well on individual stocks, or should we be using monthly charts when we review stocks?
Monthly chart a bit too slow. Daily and weekly is good enough for individual stocks. It is. But look at stocks with heavy volume, then it will reflect the emotions. All right, don't look at stocks with small volume that is more manipulated.
Okay, just a couple more questions and we end the session for today. The rest of the questions, we'll pick them up in the Q&A in our follow-up email, okay? Tom, you mentioned URL for website blog just now. Would you be able to send that across? You can type that into the chat box. In the chat box, I've also shared the link of the YouTube video for Tom's first session. So you can click on the link and catch it when you're available.
Okay.
Yeah, the other question is, can Malaysians also enjoy the IBF discount?
Malaysians,
Yes.
Malaysians, no, unless you are PR, unless you are Singapore PR. The IBF funding applies to Singaporean citizen or PR only.
Okay. All right. Thank you, Tom. One last question, and we call it a day. In your professional equities index course, does it require the use of proprietary indicators?
No, it does not. But I do introduce a couple of proprietary indicators, but you are not required to use them in order to trade, because I'm teaching you in the 2 days course. I'm teaching quite a broad selection of indicators. I'll be teaching people how to combine them to create setups.
All right, Tom, for the last bonus question, I'm not sure if you are familiar with currency futures or you actively look at it. What's your preferred time frame for the euro dollar?
Actually, it would be the same for everything, just that I do not actively trade currencies. But for intraday trading, the best time frame, whatever it is, would be a 1 hour chart.
All right, there you heard it from Tom himself. I reckon you really enjoyed today's session. I found it really, really informative as well. Thank you so much, Tom. And before we leave, just a gentle reminder, the URL to Tom's blog is available on the chat box. Okay, chat box. Let me just copy and paste it to the entire audience. Okay, it's tyfutures.com. You see on the chat box, and I've also shared the link to Tom's first webinar on 21st June. You can catch it on the YouTube link there, or if not, you can go to Philip Nova's YouTube channel and catch the video there. Okay. If you have any other questions, please type them in the survey form at the end of the webinar. For the rest of the questions, we'll pick it up in the Q&A, and Tom, I'll send you an email tomorrow, and then I'll need your help to address a few more questions for you. And once again, thank you so much, Tom, for your insights today, and thank you for the wonderful audience who stayed right till the end until we completed the Q&A. All right, to our next session, thank you, and stay safe, and take care, everybody.
Thank you. Take care, everybody.